The US-Israeli war in Iran has sent oil and gas prices surging, sparking a global energy crisis and spotlighting the use of energy infrastructure as a weapon of war. Energy stocks have risen in tandem with petrol and diesel prices, and governments are now stepping in to minimize an inflation shock. To discuss the wide-reaching impact of the war in Iran on global energy markets, I am joined by Alan Good, Director of Equity Research at Morningstar. Alan, thank you for joining us. Now, first of all, I'd like to get into the market reaction we've seen so far. Energy markets have, of course, whipsawed in response to this war, with Brent crude prices rising up to $118 per barrel at one point. That's 63% up on the pre-war levels. What is your assessment of the market reaction so far? Do you feel it is in line with the potential for a severe energy disruption?
Yeah, so we entered 2026 and with a relatively sanguine outlook, and frankly, oversupplied outlook when you think about oil, and even to a certain extent LNG. At the beginning of the year, oil prices were well below $70 per barrel. Now, as you said, we're well above 100 or slightly above 100. Natural gas prices, particularly in Europe, which are really reflect the LNG markets, have almost doubled, and it's even given those responses, the doubling of the European gas prices and the 30-40% increase in oil prices, I think the market's still maintaining a relatively upbeat view. And when you look at the potential volumes that could be at risk for an extended period, we're talking about 10% of global oil volumes that may not be able to reach the market. The idea that the oil prices are still around 100, I think, reflect the idea that we're going to get a quick resolution and reopening of the Strait of Hormuz relatively quickly, because the reality is if this situation drags on another few weeks, you're talking about removing 10% of supply of the market, and you're going to need a demand reduction of sort of the same magnitude. And you really have never seen that in the history of oil outside of that peak month around COVID in 2020. So you're talking about extreme levels of demand destruction, and we're really going to need prices much higher. So I think the market so far really isn't reflecting the potential that we're going to have an extended closure of the Strait of Hormuz, because if it was, I think you'd see oil prices, closer to 150, maybe even higher, given that amount of supply that's at risk.
Interesting. You mentioned that potential figure of $150 per barrel. We've seen some other analysts point to that, maybe even $200 per barrel if this were to be an extended conflict. How long do you think we'd have to see energy supplies offline for to get to that point? And by converse, how much do we need to see this conflict wrap up for it to fall back to sort of those pre-war levels?
Yeah, I mean, I think that for oil prices to move much higher, you're going to need signals either from the Trump administration or from Iran, frankly, doing more damage to oil infrastructure there in the region, or letting fewer vessels through. They're already letting a few, but really volume is constricted. But we've already started to see the impacts flow through to refined product prices. And it's important to remember that no one really uses oil. They use derivatives of oil, so jet fuel, gasoline, diesel. And so we've already started to see, particularly in Asia, where you've had some relatively low inventories and disruptions and concerns over supply lines, which, Asia is much more tethered to the Middle East than, say, North America. You've seen jet fuel prices already over $200 per barrel. So you're already starting to see prices at levels which you would get some demand destruction. I think, 150, you'll start to see more. Already in the U.S., you have oil prices starting to crack $4 per barrel. That's always been a magic number around where either you get sort of political pressure or you start to get demand destruction. So I think we would need to get that $150 level. But even historically adjusted for inflation, that's still not at record levels. So I think, if you look at spikes that in 2008, when we got to $150 per barrel then, that probably translates in something closer to $200 per barrel today. Natural gas is a bit of a different market. It's much more regional and based off of local supplies as opposed to the global oil market. So the U.S. natural gas prices have barely moved, despite that near doubling in Europe. So, but even in Europe, where we have doubled, we're still not even close to where we were in 22 with the Russian invasion of Ukraine. And that's when you saw material demand destruction. You saw restrictions being put in place and measures being taken to reduce demand. So we're still not even at that levels yet in Europe. So, and we are coming out of the heating season into the storage season, things like that. So frankly, I think if we're really talking about a situation when the Strait of Hormuz drags on, we're really going to see a much more meaningful price response to trigger some sort of demand destruction that would be needed to balance the market when you lose 10% of global supplies.
Of course. And you mentioned natural gas there. We've had indications from Qatar Energy that with this 19% wipeout of some of its supplies, some of those supplies could be offline for 5 years. I mean, what impact do you think that will have on those prices, and particularly as with it here in Europe, that could have big ramifications?
Yeah, I mean, it's certainly meaningful. Qatar is one of the largest suppliers in the world, but LNG market, similar to the oil market, was looking at a period of oversupply coming into 2026. So there are buffers, given that new projects are coming online. I mean, for instance, just the other day, ExxonMobil started up their Golden Pass export facility out of the U.S., and then there's more projects ramping over the next year and really next few years. So we are already looking at a situation where you're getting a lump of LNG supply that was looking to weigh on prices. And I think that view remains unchanged, and really is the reason why you haven't seen LNG prices again go crazy like we saw in 2022. So all of this is about timing again. So if the closure of the Strait of Hormuz continues to drag on, then I think you'll see a greater price response. But if we stop the situation essentially today, and you do lose that relatively sizable chunk of Qatari supply, I think there are enough and sufficient amount of global supply coming online to backfill that missing supply. You've also already seen demand destruction and switching on the natural gas side globally. So you're starting to see, news of retired coal plants start back up. And so that's going to relieve some of the demand of natural gas. And then, as I mentioned earlier, we are heading into the summer season, the refill season in Northern Hemisphere. So there's going to be less pressure on natural gas demand just from seasonal patterns as well.
Interesting. Now, of course, energy companies have been some of the beneficiaries of this conflict. What is your assessment of some of the biggest winners and losers here, and how does that fit in with your sort of view of the fundamentals that you saw going into this year?
Yeah, I mean, the whole energy complex has really been a winner off of this to varying degrees. The biggest winners by far have been refiners, particularly in the U.S. If you look at the movement in refining crack spreads, which is basically the difference between refined product prices and crude spreads, they have increased at a much greater rate than what we've seen on crude or natural gas prices. So those are, and that falls straight to the bottom line for refiners. So if you look at Valero or Marathon Petroleum in the U.S., those shares are up meaningful year to date. Any producer of oil and gas is going to be a winner as well. So if you think about the typical large integrated oil companies, Exxon, Chevron, BP, Shell, Total, these are all winners. Even if they do have some Middle East exposure, Exxon has a bit of the Qatar LNG trains. Net, they're still going to be a winner at the end of the day. When you see prices increase this much, it falls straight to the bottom line. And so they're winners as well. Even service companies, they typically ride the price in oil as well. However, they've certainly benefited to a less degree, given that they are facing some potential project cancellations in the Middle East as a result. And so they're not realizing the full benefit. So the winners really so far are the refiners and the oil and gas producers. When we look at, relative valuation, relative in the sense of looking at valuations relative to price, commodity prices today, relative to where we think they are in the future, we do think a lot of shares are overvalued particularly in the refining space and the oil and gas producers. And the reason for that really is we ultimately think that you'll get some reversion to long-term mid-cycle prices over the long term, or even really the medium term, assuming the conflict doesn't escalate and spiral out of control from here. And for us, that still means around a $65 oil price. And so if you assume that's a long-term valuation, we think the market's really sort of baking in this higher oil price in shares for the long term, which again is not our base case. Now, all that said, if we do get some escalation, if Iran starts to lob missiles and destroy more infrastructure, destroy oil fields, and ultimately, keep the Strait of Hormuz blocked, these oil companies are going to continue to enjoy very, very strong earnings that justify current valuations. Our base case, however, remains that you get some resolution and oil prices eventually fade to that mid-cycle level, in which case they look a little expensive right now.
Interesting. Now, you mentioned the potential for this continuation. We have seen some governments having to step in and implement measures to try and minimize sort of use of energy, particularly in Asia. What do you see as the likelihood of that potentially happening in Europe? Do you think we could be approaching a point like that?
Yeah, I mean, so European natural gas levels, storage levels have fallen, I think, to about 6%. And so that's near an all-time low. But again, Europe is luckily this is coming at the right time of the year where you no longer have the home heating demand. And so really what you need the natural gas for is to refill storage for the winter season, which starts later this year. Now, typically you'd see prices swoon in this time of year as you moved away from the high demand season to a storage refill season. I think the fact that you're going to need to keep prices high to incentivize that storage refill and to compete with supplies from Asia, where you normally have an abundant market, you get a much tighter market. So that's going to keep prices probably more elevated. But I don't think Europe is in the same position it was again in 2022, where you had about 40% of its gas supply turned off overnight with the Russian invasion of Ukraine. So, and prices aren't even near. I think there's still, a fraction of that level that we saw in 2022. So I don't think you're going to, given the seasonality, given the price level, I don't think Europe's going to have to take the same measures that it took a few years ago. And you are seeing demand responses in other parts of the world. As I mentioned, the coal-fired plants coming online in Asia and some other restriction measures there in countries where, obviously affordability is more of an issue. That should free up extra supply for Europe as long as they're willing to pay the higher prices. So I think unless, again, it all depends on how long the conflict stretches, how long the issues in the Strait last. But I think, if you assume sort of a price level today and some sort of near-term resolution, that I don't think Europe's got to take any extraordinary measures.
Yeah, here's hoping. Now, just finally, you've been covering the energy market for several years. What is your assessment of this potential new era that we're entering into? We've seen this real weaponization of energy infrastructure and the fact that now countries see this as a way that they can really pressure their adversaries. Do you think that this is a new phase that we're entering into and a new era, a new reality for energy markets?
I think it's probably a reawakening than it is a new reality. I mean, if you go back 80 odd years, you can point to the invasion or the attack on Pearl Harbor as a response to the U.S. restricting oil flows to Japan, right? So energy in the 20th century has always been a weapon, and I think it will continue to be as we are, in the 21st century. The reality of the situation is the reason that Iran, frankly, has deterred attack up to this point is because of the threats around the Strait of Hormuz. The Trump administration was willing to take that risk, and we are today. Again, we'll see how it resolves. But for Iran specifically, this was always going to be a pressure point or a point of leverage that they could use. And I think anytime you have the global energy source concentrated in one region, in this case being the Middle East, you're going to have this risk that any sort of fallout from a war will create pressure globally. I mean, you can even go back to the 70s with the OPEC oil embargo, and then in that case as well, which sent prices soaring. So the issue though is that we really haven't had such a problem. Even 22, as I mentioned, which is a bit of a blimp on the screen, and so we've had a compression of what you would call the geopolitical risk premium in oil and natural gas prices, right? And so that's helped with lower prices. Certainly the emergence of the U.S. as a safe haven oil producer and natural gas producer has also helped as well. But so I think what we're going to see going forward is that risk premium expand. And so even if we get a resolution in the Strait of Hormuz, even relatively soon, you're going to see that risk premium remain, higher than I think it has the past few years, given the possibility that war erupts again. Otherwise, I think ultimately supply demand will dictate prices in the long term. And again, once we get this situation sorted, assuming it gets done relatively quickly, the world seems to be relatively well supplied on both oil and natural gas.
Alan, thank you so much for your time. For Morningstar, I'm Karen Gilchrist.